What's going on, you guys? My name is Zach Hartley, and in this video I'm going to walk you through the first steps that you should take to start your investing journey in 2021. Here is everything you need to know. Let's go. Alright, so step one is to pay off any high interest debt. If you have any debt at all, whether it's a credit card, a line of credit, student loans, whatever it may be, if it's over about 5% interest rate, it's going to be better to pay that off than to invest your money. The reason is because from a cash flow perspective, if you take your extra $200 per month and you pay off that debt that has a 5% interest, it is the exact same cash flow wise as investing that money and making 5% in the market. The only difference is when you pay off that debt, it is a guaranteed 5% return. You know 100% you're going to save yourself 5% interest instead of the likelihood or the chance of losing your money, investing that money and losing a couple of percent. You know that when you pay off your debt, that return is 100% guaranteed, and that is why you should do it. However, if you have a mortgage that is at 2 or 3%, you can probably get a better return in the market. You can at least get 5 or 6% in the market, and that means that you're going to be able to make more money, and it makes sense to keep that mortgage, keep that debt, and invest your money. So it really depends on what the interest rate is on your debt. That is what is going to decide should you pay it off or should you hold that debt and invest your extra money, and it's usually around that 5% level that it starts to make a big difference. Now, step two is to hold an emergency fund. I highly recommend holding between 2 and 6 months worth of expenses, either in cash or in a high interest savings account. What that means is saving up your money and making sure that you have a backup plan in case your car breaks down, in case you get sick, in case something bad happens. You have all of that money that is tied up, that is there, that is ready to go, that can be pulled out of the bank in 1 day's notice and is not susceptible to the fluctuations of the market. So if the market crashes, you still have your 4 months emergency fund there and ready to go. I highly recommend you keep an emergency fund as a backup before you invest any of your money. Now, once you are ready to invest, I highly recommend the first thing that you buy is an exchange traded fund, otherwise known as an ETF. The advantage of an ETF is that it's similar to a mutual fund. However, it has much lower fees and you can buy and sell it like a stock. A mutual fund, you have to call up your broker and say, hey, I want to get out of this, and he can't even pull you out till the end of the day. If you decide that you need all of your money right now, you can go into the market and you can pull out all of your money in an instant if you own an ETF. It is bought and sold just like a stock. However, it represents a group of stocks. So you can buy an ETF that represents the market in the S&P 500. You can buy an ETF that represents a variety of e-commerce companies. You can buy an ETF that represents a variety of clean energy companies. I'm going to show you all of those examples in just a minute here, but the reason that I say you should buy an exchange traded fund first is because they have very low management fees, and when you buy a group of companies, you're getting instant diversification, so you don't have to worry about making 10 trades in 10 different companies and paying 10 different commissions. You can make one trade, you can buy one ETF, and you can get instant diversification and only pay commissions once. You also don't need to rebalance that. It's going to auto rebalance for you. It has extremely low management fees, and you can get in and out of it on your own at any point you want. That is why it's better than a mutual fund, and that is why I highly recommend it. It's because it's going to give you that instant diversification. You're only going to pay one commission. Now, there are a variety of different ETFs that you can buy into, and I've put a list here of some of my favorites. So the S&P 500 is basically the 500 largest companies in the US, and that is basically the broad market index. When you invest into the S&P 500, you're basically investing into the United States market, and you can do that by buying 3 different ETFs. They're all pretty much the same. However, these are the tickers. So you can go SPY, you can go VOO, or you can go IVV. All of them are pretty much going to give you the same exposure to the S&P 500. Now, if you want to focus a little bit more on technology, I would recommend the NASDAQ. You can buy into a NASDAQ ETF under the ticker symbol QQQ. You can also buy into the Dow Jones under the ticker symbol DIA. That's a little bit more industrial. If you're looking for e-commerce play, I highly recommend eBiz, EBIZ. When you buy this ticker, you're going to buy one share of eBiz, and it's going to give you exposure to a variety of different e-commerce companies. That's the idea here, and that is the benefit of exchange traded funds, is that if you're starting with a small account, in order for you to get diversification, you need to hold 5 or 10 different positions, which means you're going to be paying 5 or 10 different commissions. When you buy an ETF, you only pay one commission. Now, the last one on this list is a clean energy ETF, ICLN. You should definitely do your research on all of these, but these are the ones that I highly recommend and that I think are pretty popular and will do well over the next 5 to 10 years. Now, the big question is, what trading platform do you sign up for as a new investor and as a new trader? Well, it depends a little bit on where you're located. I'm located in Canada, but I know a lot of viewers are also in the United States. So if you're a casual investor that is looking to operate this from their phone and just do this casually, I recommend Wealthsimple if you live in Canada, and I recommend Robinhood if you live in the United States. They're the most user-friendly applications. They're the easiest to set up. They're the easiest to buy and sell your stocks with, and you can usually do it with free commissions when you use one of these platforms. Now, there are some drawbacks to both Robinhood and Wealthsimple. For instance, you can't put a trailing stop loss on any of your trades. You can't do a ton of research on any of these platforms. There is very, very limited data on Wealthsimple and Robinhood, and that limited data makes them very easy to use. However, it is limited, and so if you're a more advanced trader or you're pretty serious about getting into this and maybe doing some swing trading and some day trading, then Robinhood and Wealthsimple probably won't cut it for you. And if you're in Canada, I highly recommend using questrade. Now, there's a link down below for $50 in free commissions, so you can sign up for it, you can use it, you can try it out, and it won't cost you anything. And if you're in the United States of America, I highly recommend Thinkorswim. That is what I find that most of my American friends and traders are using. However, every platform is going to have a glitch now and then, and you just kind of have to deal with that. Now, once you've got some of your money into an ETF, I highly recommend between 25 and maybe 50 or 60% of your portfolio should be in an ETF, because that gives you very good diversification. But the rest of your money, however much you decide to keep with and play with, I think you need to decide, are you going to be a high growth investor or are you going to be a dividend and cash flow investor? So what I mean by that is, if you are looking for high growth stocks, you're looking for companies that are going to be the next Apple, the next Facebook, that are going to grow exponentially over the next 5 to 10 years. That is one investment strategy. However, another investment strategy could be investing in dividend stocks, stocks that are going to pay dividends or going to provide you with cash flow. So Costco, for instance, pays a quarterly dividend back to their shareholders, and you can rely on that money every single quarter from Costco. The same thing with Caterpillar, the same thing from Coca-Cola, for instance. All of those companies pay a dividend that is going to give the investor cash flow. All of the technology and high growth companies are never going to give the investor a dividend back, or at least not anytime soon. And so what I think is really important is for you to figure out, are you going to go out there and look for high growth companies, or are you going to go out there and look for dividend and cash flow companies, or is it going to be somewhere in between and maybe a mixture of both? I highly recommend one or the other, but both is definitely an option as well. Now, if you're looking for high growth companies, these are going to be the stocks that are going to grow quickly over the next 5 to 10 years. In my opinion, the industries that I think are going to be high growth over the next 5 to 10 years is technology companies, gaming companies, drone companies, e-commerce companies, and psychedelic companies. So we've seen a massive run up in some of the psychedelic companies lately. Gaming companies have been absolutely on fire. I'm currently invested in a couple different drone companies, and technology is leading the way over the last few years, and I don't think that is going to change. So if you are interested in high growth companies, I think these are some industries that you should definitely look at. However, if you're interested in dividends and interested in cash flow and bringing in consistent revenue, then these are some of the companies that you may want to look at. And so when I talk about dividends, I'm talking about finding stocks that currently pay a dividend and will hopefully raise their dividend in the future. So bank stocks are really good in both Canada and the United States. I highly recommend real estate stocks or REITs. REITs stands for Real Estate Investment Trust. They're basically like a company, except they're legally mandated to pay a dividend, whereas a company can change that dividend at any point. So real estate is a really good area and a really good industry to be in if you're looking for dividends and cash flow. The other industry that I like is grocery companies. So I really like Costco. It's a great company. It's extremely well managed, and they're very consistent with their dividend and increasing their dividend. So I really like some of the grocery stocks as well. Now, if you're interested in learning how to understand these companies and find these different stocks, whether it's dividends or whether it's high growth, you should definitely consider signing up for my stock market course. It is a 2-week free trial. There's 9 hours of content in the course, and we just passed over 1,000 students in the course. I'm extremely happy with that. There's over 60 plus reviews for you to read. It is hosted on Skillshare, and like I said, it is completely free when you sign up for a 2-week free trial. There's a link down below in the description to this video, and I promise you it will be the best free resource that you've ever found in your life. Now, before you make your first trades, you need to understand what type of account you're going to make those trades in. So if you're going to swing trade and you're going to do short-term investing and possibly day trading, I highly recommend you use a margin or a cash account. However, if you're going to be a long-term investor, you're holding these companies for 6 months, 1 year, 2 years, longer than that, then you're totally fine to use a tax-free savings account, an RRSP, a Roth IRA, or any other type of registered account. account. The real line that you need to be well aware of is when you trade for income, it needs to be considered as income. It cannot be considered as capital gains like what you take advantage of in some of these registered accounts. And so you really need to understand that. And so here are the rules. In the United States, you cannot trade more than 3 times within a 5 business day period. Otherwise, it is referred to as the pattern day trader rule, and you can face a couple of penalties for that. In Canada, we do not have a clear rule that is set out like the United States does. However, what they are concerned with is you trading, day trading and swing trading as a regular job and making income from that job and then claiming it as capital gains for a tax advantage. That is what Canada is concerned with. Same thing in the United States. They're both concerned with that issue, and so you need to be very careful. If you are a short-term trader, you're probably better off in a margin or a cash account, and if you're a long-term trader, then any of these registered accounts are totally fine for you. Now, if you're interested in a video that actually dives into this topic for Canadians, I do have a video on my channel, TFSA Day Trading and Investing. You should definitely check this out. And these rules are dramatically oversimplified. You definitely need to do your research if you think you might be kind of on the line. All right, now in summary, you need to pay off your debt and you need to keep an emergency fund. Those are the 2 things that you need to do before you start investing. Number 2 is you need to build a diversified portfolio, and you can do that in one trade by buying into the right ETF. So make sure that when you get into investing and you get into trading, don't go out and start speculating on biotech stocks. Diversify your portfolio, buy into an S&P 500 ETF, buy into the clean energy, buy into the e-commerce, and then start picking and choosing the individual stocks. That is going to be the best way to do it. I absolutely guarantee it. Next one is decide what type of investor you're going to be. Are you going to look for high growth companies? Are you going to look for cash flow companies? Or are you going to be somewhere in between? It really does matter, because having a clear strategy is going to improve your results over the long term. And when I say strategy, I clearly mean written down strategy. When are you going to buy? When are you going to sell? How are you going to manage your risk? And if you want to learn more about that, I have a 1-page trading strategy on my YouTube channel. Definitely check that out. And if you get any value out of this video, please consider hitting that like and subscribe button. It sincerely helps me out. Good luck trading. Good luck investing. We'll see you guys in the next video. Happy New Year.